Hello everyone and welcome to today's webinar on making the most of TCFD. Before we get started, I would like to go over a few items so you know how to participate in today's webinar. You've joined the presentation listening using your computer speaker system by default. If you prefer to join over the telephone, just select telephone in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit your questions to today's presenters by typing your questions into the questions pane of the control panel on the right-hand side of your screen. You can send in your questions at any time during the presentation, and we will collect these and address them during the Q&A session at the end of the webinar. This webinar is being recorded and will be sent to attendees afterwards via email. I would now like to introduce today's speakers, Dominic Burbridge and Ben Peel from the Carbon Trust.
Brilliant, thanks Maddie, and welcome everybody to today's webinar on Beyond Disclosure, making the most of TCFD. My name is Dom Burbridge. I head up the work we do at the Carbon Trust around climate risk and resilience, and I'm joined by my colleague Ben Peel. So in terms of today's agenda, the aim of today's session is to cover off the following 5 key points. So we're going to start with a bit of a recap on TCFD so as to kind of get everybody all on the same page. We're then just going to give you a very brief update on the latest FCA requirements, so the Financial Conduct Authority and their recent announcements over the last few months. And then finally, we're going to, well, as a third point, we're going to explore the advantages and disclosure of TCFD with some insights from a survey that we did recently of top UK companies. We'll then move on to a little bit around the latest state of disclosures. So we're going to sort of dig into the 2020 report that highlighted what companies are doing to date in terms of TCFD disclosure. And then we're going to finish off with a bit of a sort of a deep dive in how do you look beyond compliance to kind of really uncover the strategic business value of responding to the TCFD requirements and what the benefits are of getting organised in 21-22. So that's what we're going to cover today. Before we do that, I'll just, for those of you who don't know us, a quick introduction to the Carbon Trust. Our mission has always been and remains to accelerate the delivery of a sustainable low carbon economy by helping businesses, governments and organisations globally to reduce carbon emissions and really focus on resource efficiency. We've been in business for 20 years. We're now a global company of more than 200 people representing more than 30 nationalities and based across the 5 continents. And we use this as the basis to work with corporates, cities, regions and governments, and through our green finance work, also with investors and financial institutions. And a key part of what we do, beyond the advice and the assurance and the endorsement that we provide for companies and organisations that are taking action, is also the work we do around the development of low carbon technologies and solutions. In terms of why the Carbon Trust when it comes to TCFD, well, we work across the full range of stakeholders. We've been working with corporates for a number of years, providing bespoke advice in this area and really trying to help them navigate the benefits and mitigate the risks of TCFD. We're also working with investors and obviously policymakers. I think the reason why we're well placed to do this is that we have a strong track record in providing corporate sustainability advice. Our mission has always been to turn good environmental performance into competitive advantage and really help businesses protect and grow business value. And we have a strong track record of doing that. So enough about the Carbon Trust. So now let's just move on to a quick recap around TCFD. So the first thing is really just to get orientated about, what are climate-related risks and opportunities. And if you look at this chart on the right, what we've tried to do is show the 2 dimensions of climate risks that a business may be exposed to. So on the bottom axis, we have physical risks, and you can kind of see, and this is physical risks are directly correlated to the actual global temperature. And as global temperature rise increases, then the nature and magnitude and likelihoods of physical risks increases. So you can kind of see on the far right-hand side of this chart, if we do nothing, if we fail to act, then we're going to experience a world where we have runaway climate change and temperature increases to get well beyond 6 degrees. And this obviously has coined the phrase a climate breakdown, and that is the consequence of failure to act. Now on the vertical axis, what we have is transition risks. Now a transition risk is coined because it is the risks and opportunities associated with the transition to a low carbon economy. So in an ideal world, and what the world has agreed to do through the Paris Agreement is we will be aligned in this transition to a low carbon economy. And this means that we will all work together at a global level to keep global temperature rise to below 2 degrees and strive to keep it well to below 1.5 degrees. Now, this transition can really happen in one of two ways. It can either happen in an ordered and clearly laid out and signposted transition, where we all work together and all countries and companies have a clear path laid out for them. Or alternatively, it's going to happen in a much more fragmented and disorderly manner. And in this way, we'll see the rise of policies and legislation and changes in different parts of the globe at different times. And for multinational companies, this could comprise a real problem. So hopefully this chart sort of gives an explanation about those two extremes. We have a climate breakdown, or we have an orderly transition to a world which is Paris aligned. Now, somewhere in between, there's a mixture of both of those scenarios. And you can kind of see this is the world of uncertainty that we really want to deal with. And this is why TCFD came about. So if we talk about TCFD, this is the classic chart. When the framework was first announced in 2017, this very much tried to show how an external factor, such as these climate-related transition risks and opportunities and physical risks, how those external factors can have an impact on your business, the whole value chain of your business, and how those external drivers can create an internal financial impact. So this is how you can, and this is the model that you can use to try and translate this external changing environment and see how it has an impact on your business, whether it's on revenues, your costs and expenditures, whether it affects your assets and liabilities, whether it affects how your business is financed and the capital that you use to create value. So TCFD was created by the financial industry for the financial industry. What they wanted to do is to make sure that every organization that is being lent money, or is being invested in or insured, that every organization has thought about how these long-term and constantly changing external drivers associated with climate change, how are they going to affect the ability of the business to protect and create value in the future. So in very simplistic terms, TCFD literally is it's about getting the answers to these 11 questions. So the 11 questions are categorized into 4 different areas of governance, strategy, risk management, and metrics and targets. Now, originally TCFD was voluntary. As I say, it's been around since 2017. But as of December 2020, the FCA announced that beginning on or after the 1st of January 2021, all premium listed companies would need to report on a comply or explain basis using the TCFD framework. And the areas that we've highlighted in green are, with the green boxes, are the focus areas for that FCA requirement. Now, as of March 2021, so only just last month, the FCA also announced a consultation as to whether to extend these requirements to all large companies. So this is, details of that consultation can be found on their website. So I think what we can see is that over a relatively short period of time, from 2017 through to 2020, we've moved it from it being voluntary to seeing that TCFD very much is going to be mandatory. So, the real big question is, well, what's the benefits of these disclosures? And, as a business, how can I really capitalize on this opportunity and really turn compliance into a benefit? So actually back in 2019, we actually went out to businesses and asked all of those questions because we wanted to really understand how well do organizations understand the benefits of TCFD, and what are the perceived benefits of providing these levels of enhanced disclosures through your financial reports. And at the time in 2019, you could kind of see that there was already a lot of people saying that they were disclosing climate-related risks and opportunities, and that the plan was that 23% would be disclosing fully in line with the recommendations of the TCFD, by the end of 2019. And we also saw that 37% of companies were actively engaged by their investors on climate change in the last 12 months. So we can kind of see that classic push and pull. We had investors and lenders and the people that provide the finance for businesses asking for these disclosures, and we've also got companies saying that they're going to deliver on that. And that gap has definitely been closing. In terms of the perceived benefits, actually, you can see that there was already people had a strong awareness of why we should be doing this. 72% believe that the increased brand value. 37% believe that it would really help with reducing shareholder pressure and activism, because you'll be showing your stakeholders exactly how you're responding to this big external risk and opportunity. Other benefits were that 29% felt that it could help with diversification of investors, and even 21% felt that it could lead to increased company valuation. So in other words, all that effort that had been going into the sustainability teams, this was now starting to be recognized by investors, lenders, insurers, and stakeholders. And so ultimately, I think this really set the tone for us, is that we really felt that TCFD was definitely going to be much, much more than just another compliance activity sitting on top of mandatory carbon reporting or ESOS. TCFD was very much an opportunity for businesses to tell their story in an engaging, transparent, and comparable way. As times moved on, we thought it would be useful to kind of analyze a bit of the status report. So each year, TCFD issues a status report. This is based on their 2020 findings. And on the right, hopefully you can kind of see a bit of an excerpt from their report in terms of who and to what degree, what are the trends around how companies are answering the questions, those 11 questions. So earlier, I showed you those 4 different categories of governance, strategy, risk management, metrics, and targets, and the 11 questions that sit underneath those. What we can see on the right is the trend. So over time, this is the number of organizations that are based on their survey that are actually disclosing information associated with those questions. And I think it's worth drawing out some trends here. So I think the first thing is that obviously there's been some good initial disclosures. So if we look around here, you can kind of see that in terms of the strategy questions, over time, more and more organizations are talking about the impact of climate change on their business. And historically, there's been a very good disclosure, up to over 40% of companies can actually list the material risks and opportunities that are affecting their business. I think what's interesting is to see that that's slightly stagnated. So there isn't so much growth in that area anymore. So clearly there's an opportunity for the 60% or more companies that aren't disclosing this to do more in this area. I think what's also worth sort of flagging is that around the risk identification process. So if you look at the questions around risk management, this is all about asking how is climate-related risks integrated within your normal risk management process within your business. Do you have a process for flagging up those climate change risks, for assessing them, categorizing them, prioritizing them, and then including them as, where relevant, as principal risks on your risk register. And you can see that actually this is the area where there's been the greatest amounts of growth in terms of that risk identification and assessment process. And I can only see that as increasing as time goes on. I think where there's been some sort of real challenges has very much been around ultimately that final part of integration of risks. So people are quite good at identifying risks and they have an existing risk management process, but is it actually baked into and incorporated within the core risk management process of the business? That's where we're seeing a bit of a gap. And I think the other big area, which has always been a challenge for business, is this around the resilience of your strategy. And this is very much around that scenario analysis. Now for us, when it comes to scenario analysis, this is about testing the sensitivity of those risks and opportunities that you've identified. How sensitive are they to different climate scenarios? The sort of, as you said, that sort of that climate breakdown scenario or that Paris alignment scenario. And if the world moves in one direction or another, how does that value at stake change for your business? So that's the key focus area for businesses going forward is again, that scenario analysis. So hopefully that's given you a bit of an insight into kind of where is everybody on this journey. I think in the next slide, I just wanted to give you an example. This is a case study of National Grid, and we looked at their disclosures over the last 4 years. So they were a key signatory to the supporter of TCFD, starting right back in 2017. And you can see there that right at the start, their first disclosure was basically just a clear intent to comply with the recommendations. Then as time has gone on, and as they've worked through what the implications of climate change are to their business and how it overlays onto their business model, their value chain, and how they create value, we've seen the levels of disclosure increasing over time. So you can kind of see in 2018-19 versus 19-20, say under governance. So at first they highlighted that, yes, we're having board level discussions around climate change. By last year, it was clear that they now had full board level oversight. I think in terms of the strategy, you can see how it went from only a couple of years ago, they had 3 risks and 6 opportunities identified, through to most recently, they've basically now got a scenario that talks about how climate-related risks affect their whole value chain. And they've clearly identified what the opportunities are, but still not yet quantified that. And I think what really stood out in their most recent report is that under the risk management, climate-related risks and opportunities were now identified as a principal risk in their risk register. So you can kind of see how this transition has changed over time. In terms of metrics and targets, National Grid have always had very good information around the scope 1, 2, and 3 carbon footprints, but they're currently now working on what are the meaningful KPIs that really show how they're managing and capitalizing on climate risks and climate opportunities. So I think the key observations from this is that meaningful disclosures take time to get everyone on board. The old adage that this is a marathon, not a sprint, really holds true. TCFD is very much around a transformational mindset, and what they saw for their business was that TCFD is not just for energy-intensive industrials. It's also about for anyone where there are risks and opportunities. So hopefully this gives you an example of the sort of journey that you might go on and that businesses need to go on. I'll now hand over to my colleague Ben, who will talk about, the climate emergency and the transition to a prosperous low carbon economy. Ben.
Thank you. Yeah, and very much within this context, it's thinking about some of that mindset that's successful when it comes to looking at these the risks that are coming, and also observing just how the markets are changing within the context of how companies are developing their strategies. Because certainly, we hear a lot just generally the importance and growth over the next kind of 10 years as being kind of a key critical transition for companies, not just in relation to climate change, but in major changes in how business models are changing. And in terms of the mindset, certainly within the physical risks that we've mentioned, these are really now at a point of no longer being sort of this thing that's on the horizon, and it's very much evident, clearly observable, and kind of a new way in which most companies are already having to operate and respond to these direct physical risks. So obviously, looking at on the chart here, seeing that shift change in the sort of scale of key natural catastrophes and disaster events, and there's just a real kind of separation between what's come before and where we exist now in terms of the last 5 years. But even just reflecting on the last few months, obviously we've seen the major Texas snowstorms that were at the time unprecedented and won't be again. And in the last month, just the kind of major flooding following wildfires in Australia, putting over 10 million people at risk. And even in the UK, if we just reflect on the last 12 months, we've seen both some of the hottest at just topping up near 38 degrees and coldest at below 20 degrees in the last 12 months. So a 60-degree swing in the UK temperatures, which again, the extremes and the transparency with which the climate and those physical risks are present, not just future, are very much becoming clear now. And in terms of the nature of these risks and how that sort of mindset around them that we've seen to be kind of very successful, and really the way to embed these is understanding that one part, these are very much systemic risks. Climate change is going to affect all agents in the economy, and for many this is not just the direct impacts, but really how the system is vulnerable and the shocks the system will propagate, and those knock-on impacts. And I think that's no more evident than just also in the last year, where we've seen many companies suddenly recognize their vulnerability to systemic shocks as a result of the pandemic, and obviously we see those systemic shocks being something that most companies will have to deal with on a more frequent basis as a result of also continued extreme and frequent physical risks as well. And also, these risks are also kind of not something that we can look at on the basis of past experience being a strong predictor of future outcomes. It's very much that the impacts will become larger at pace, more widespread and more diverse than those of just looking at how things have developed in the past. And this is very much the kind of non-linear nature of these physical risks. Is preparing just for kind of what you see right now is going to be insufficient, and very much that when we're looking at physical risks, it's about preparing for those greater extremes and frequencies at a very different level. But at the same time, we look at it can be one of those things where physical risks are very much looked as being nebulous, very difficult to predict, and very hard to understand. But it's very true that they are foreseeable in a way that is there's a strong degree of confidence and certainty that we're on a path to increasing and accelerating those risks. There will be some sensitivity around the outcomes, specifically in the time horizons that they take place over. But building a resilience to them is very much a good bet, because they are foreseeable and we're on the path to seeing those risks. And that really leads into the other element highlighted here, is that also that once we've observed those risks are very much here to stay, and that as we move past those risk thresholds, that is the nature of the way in which your business will continue to need to function is with that level of risk, and it will then be increasing over time. So once these physical risks are observed, it is very much being clear that is in the mindset that is they're here to stay, and that is the nature of how you need to build resilience for the future. So I think on that basis, this is just some of the mindset around physical risk to be aware of. And on the transition, what we're seeing over the last year to 12 months is that we are getting closer to some of those key tipping points and inversions within a lot of key sectors, and the possibility of that transition is becoming ever clearer, with many people questioning more about the question of when, no longer so much around if. And that's across a lot of the kind of key carbon intensive sectors that most companies are reliant on in some way or another. In the power sector, obviously, the change in renewables and the real competition with fossil fuels is no longer something where the cost-effective solution continues to be the fossil fuels, that is very much inverted, and now it's the government support for fossil fuels that is keeping them competitive rather than the other way around, and for large parts of the world. And obviously we've seen the sort of fragility of some of those fossil fuel companies in the recent years, and that's obviously why for them climate risk is not a problem that is only being faced this year, but one that is already very high on the agenda. But also in terms of the transportation sector, yeah, very much that with a shift in kind of what the automotive giants are banking on, and that shift to new drivetrains, electric vehicles are no longer just kind of a fringe share of the market, and very much we see the penetration there into the kind of mainstream, with that market share very much shifting. And yeah, a couple of other points just wanted to flag here around kind of the way in which the agriculture sector, those things that have been major concerns and once considered kind of unstoppable dietary trends, that we're seeing the potential for that turning a corner as cattle, as by far and away the largest contributor to climate change across the overall sector is plateauing. But also, we're also seeing that within the kind of circular economy sector, that waste strategies, particularly in Europe, are becoming far more kind of clear and the direction of travel is now much more certain. And from that standpoint, yeah, very much that the policy is now looking to commercialize and support those areas. And I think just because those inflection points are getting closer does not mean they're yet here. And the uncertainty has certainly been narrowed and not, but it's not fully removed. And also, while we've seen kind of clean energy investment at a new high at over $500 billion, we also have seen a lot of government financing going into the high carbon sectors in the route to COVID recovery. So, as I say, those transitions are coming closer and clearer, but it doesn't mean that they are, just on a smooth pathway to being delivered. And so very much that's where the element of kind of the opportunities will come into this, is that there definitively will be winners and losers, and the winners are those that are going to be able to manage the uncertainty of that transition, and particularly by sharing the burden of investing in and innovating within this space. So while we know the technologies that we require, and these are technically possible to achieve, the scaling up is really the next round of kind of key action that will be taken and to unlock that next phase of deep decarbonization. And that's going to come through from organizations that can see not just the challenge, but how they can contribute to the solutions. So, looking at each of the kind of stakeholder groups, each of them will need to kind of work to their strengths. But when it comes to assessing the opportunities from climate change, it is very much understanding your strengths, but also identifying which partners are going to be those that kind of co-create the solutions alongside you. So in terms of mindset, that's just some reflections we wanted to think about in terms of how successful companies are approaching TCFD in terms of thinking about these risks and opportunities. But also, moving on to the kind of pressures that are coming externally. So not just the pressures of a changing world, but also the pressures that come from the investment community. So we're also seeing, particular kind of change within this space, and the mindset that needs to be responded to here is very, very, very clear, much clearer now. So we wanted to highlight, just that, for example, the Net Zero Asset Alliance represents $5.6 trillion of assets under management pushing towards net zero across the financial sector. But the financial economy will only achieve net zero when the real economy does, and that means individual companies, but also these entire portfolios of companies that they are invested in need to be on track to achieve that net zero goal. So it's not about betting on one, but ensuring that a whole group of companies are all working towards that net zero solution. So those companies in the portfolios that these investors are managing and the real economy as a whole will only achieve that net zero position when the impacts on the planet are appropriately valued and sectors are operating within those boundaries that are set in terms of achieving our global climate goals. And very much a key part of TCFD is really putting a value on taking action on climate change, building resilience, and being able to price that risk of inaction effectively. So while some institutions are certainly kind of pulling companies also investing in those that are going to be successful and the ones that are providing solutions, that's not going to be sufficient to do everything. And we're also seeing that those investors are under their own pressures. So while there's the mandatory element for companies themselves, that investors are also, under the pressure to integrate climate risk into their interactions with companies throughout their portfolios. So we wanted to highlight here the need for the stress testing to assess as a portfolio the impacts of physical and transition risk for thousands of companies as a whole, and seeing where those real concentrations of risk. And while that won't affect their balance sheets yet, it will provide a quantitative view across the market for the different levels of risk across each financial institution, but also within each of their portfolios. And also, what we're also seeing is the early adopters of really understanding, those companies that understand the opportunities, but also want to decarbonize and de-risk effectively. There's really a clear program of kind of creating and capitalizing on the opportunities. And also particularly that we've seen some really positive trends in the kind of decoupling of those green bonds from the broader bond market in 2020. So green bonds, in terms of the companies that have raised those bonds towards green activities, have basically outperformed the global bond market in 2020 when you compare the indices for those green bonds specifically as compared to the aggregate total return for just generic index. So very much kind of seeing that the capitalization on opportunities is really being linked to outperformance. So in terms of what this means in terms of why the disclosure matters, is that investors need to make decisions on who's on the right path to transition and who is building resilience, along with where there's hidden risk as well within their portfolios. So this really is pushing a lot of need for data and input into their assessment. So as I say, with the pressure that the financial institutions are under, there's a need to find answers to where risks lie in portfolios and which companies are managing them best. So that also means that they are assessing those risks outside of what is disclosed and outside what is presented to the market by the individual companies. So there's a proliferation of tools and methods out there to assess risk in the absence of the correct information or the right information. And what we also see is that disclosure is moving from being ESG on the basis of performance to ESG on the basis of pricing of risk. And so certainly controlling the narrative through the way in which disclosure is presented, so that showing that climate is embedded into the way the business thinks, plans, and is building a strategy for a sort of changing future, and one that is dominated by climate change, is really a critical part of how that disclosure can be leveraged. Because those disclosures that are generic or that provide limited information, again, as I say, there's a need to then fill the gaps through estimation or through assumption. So disclosure is certainly the means to dealing with that effective engagement by showing that climate is top of the agenda, that there's a clear purpose and clear understanding of how climate change will affect the business and how the business is responding to it, and also what the business is doing to align with the consistency and comparability of what others are doing. So showing where the business sits within the sector, and particularly how it is better prepared for that future as compared to its peers. So very much why we see going beyond just ticking the boxes on disclosure and really building that overall strategic position is really, really critical for that decision making as well, in terms of how that engagement will happen between companies and their investors. So now we just kind of wanted to reflect a bit on our experience of working with companies and how they are really effectively engaging on TCFD and how they can get the most out of it. Some of the things that we do, and I guess starting off, just a little bit of kind of myth busting about some of the things that we hear. So we certainly hear, to a degree, that it's just, as Dominic was saying, is that it's just another round of compliance. It's another thing to do. And I think we really see that, as I said, there's going to be winners and losers in that transition. And TCFD really provides this framework and opportunity to show how you're thinking ahead, planning for that future, and planning for a world that is fundamentally very, very different to the one that you're currently operating in, and that you're ready for those changes that are coming through. Also, that scenario analysis piece is often something that is very much presented as it's too difficult, it's too uncertain. I don't know where to start. And I think what we'd say is that the reality here is that what needs to be done is finding really what the right questions you're trying to ask the business are. so that you can answer those through scenario analysis. It's not a case of just trying to apply scenarios in a complex and ultimately not very valuable way. It's about understanding what questions you want to understand, you're trying to find the answers to, and then using scenarios to support that understanding of where the sensitivity lies within the key areas of value creation in the business. So we definitely see that scenario analysis comes at the right place and comes in the right part of the process, but it shouldn't be the thing that you just kind of front up at the start and then hope it gives you the answers that you might want. And then yeah, I think on the other area around kind of TCFD alignment, it may be kind of 11 questions, but it can seem very intimidating to kind of really look at climate change across the board in such a detailed way. And as Dominic was saying with the kind of case study presented, but also just what we've experienced in terms of that investor dialogue as well, is that there's definitely a minimum expectation in terms of making sure you're putting a good first position out there, but recognizing the faults, recognizing the gaps, and recognizing that this is a multi-year process is very much a key part of this, because part of this is around that engagement with your key kind of partners and stakeholders to really understand what is needed by them, and using initial disclosure as the key way to structure that dialogue in the future as well, rather than leaving it as just you need to do TCFD is not going to be the way to get that conversation going. And then yeah, I think what I was hoping to sort of bring out is that every sector is really exposed, and that exposure can be controlled by the decisions and strategies we're putting in place today. It's not a just a 10-year problem anymore. This is very much the planning horizon of businesses will be impacted by these climate risks, and making sure that those exposures are understood and that you understand which decisions are most impactful to either enhancing or reducing those exposures, really going to be critical in the coming year. I think also, yeah, when we talk about climate change, I think many may be reflecting on this right now, is that many of the risks are well known already. There's a lot of information out there on climate change, and therefore that people recognize a lot of the risks that they face. And I think what we'd say is that recognition is not the same as readiness when it comes to these risks. So knowing that those risks exist is okay, but really knowing that you're ready for both the scale and speed with which they're developing is a very different position to be in. And the process of going from one to the other is where the value really lies, in terms of actually making sure that it's not just something that's there as we're aware of these things, we kind of know that they exist, to we're actually making plans to deal with them, is very much kind of the shift that needs to take place. And I think in terms of this being a reporting matter, yes, obviously it's mandatory. Yes, it's going to be coming through and making sure that you're achieving those goals. But very much that we see that it's doing this on the basis of making sure that this is part of the senior leaders' agenda, making sure that governance element is done correctly is really key, but also that climate becomes part of the core planning of the business, so that when business thinks about its strategy over the next 5 years, that climate is a key part of that, and it's not just the ownership of that doesn't sit just with the sustainability department, but with the core way in which you're planning for value creation over the coming years. I think just in terms of the ways, and also we see kind of successful thinking around this, is that it can be easy just to kind of look at when there's transition risks and physical risks, just kind of look at either end of the spectrum here. So just focus on what are my carbon hotspots, that's where the transition risk is going to be, or just look at where are my operations, where are my assets, where are my sites, what are the sort of direct physical risks to those sites. Yes, those questions definitely need to be considered and answered, but really where we see the kind of most opportunity and kind of broader resilience being delivered is where we go beyond this to understand some of these other kind of key areas and hotspots, because really, like climate transitions will fundamentally require a change in how resources are used beyond just looking at the carbon. Carbon is often the symptom rather than the underlying cause for a lot of these hotspots. So understanding that resource use intensity is really a key way of understanding the actual kind of opportunity that exists and the way in which the structure and strategy of the business may need to change. But this also allows you to bring together a number of different topics across the way in which you're already thinking about some of these areas, including thinking about water use, land use, forestry, some of those other key kind of critical inputs to the kind of raw materials that you're reliant upon. In terms of the systemic risk, I think this is a key area where it's really important to find the kind of pinch points within your value chain to understand the vulnerability that can be cascaded to you through your key partners or the commodities that you're effectively kind of using and critical to the value creation of the business. Because what we're looking at is that all of that will become more uncertain, and the secondary and indirect impacts are often the most disruptive to businesses, not just those that kind of directly hit them on their own operations. And then really examining what your wider stakeholder group really cares about is something that is always in our minds, but actually doing so on a kind of comprehensive basis is really really key, and that's often where the understanding of that co-creation opportunities can really be uncovered as well. In terms of how we generally go about this, the way in which we try and structure our process is making sure that there's a lot of engagement up front with the key stakeholders across the business, make sure that the TCFD project is done in a way that integrates the thinking across the business, is not just done in a kind of silo, and making sure that really the understanding the kind of business context within the sector is a critical part of that. And then really making sure that the way in which risk and opportunities assessed is broad at the outset, making sure that you identify those risks and opportunities that will have a material impact on the business, but really understanding and looking at those different lenses to uncover where those risks exist, so that you don't just focus on the obvious, but also look at the kind of where the hidden risk is going to be. And then I think that's where we see then the scenarios coming into play, is once there's a clearer view of exactly the scale of those risks. It's important to use scenarios in a kind of robust way that is also around understanding the sensitivity of those risks. So really understand and prioritize on the basis of the evidence used in the right way, making sure that it's connected to financial outcomes, of course, and making sure that you're using the right kind of relevant, robust climate change data when assessing the materiality of risk over your planning horizons. But ultimately, this is around getting down to sort of the key elements of this. So really understanding, where do I need to report on material risks and materiality on the basis of the business assesses materiality, not just materiality in the context of these risks in isolation, but how is it related to the overall kind of key other principal risks that the business is facing, and performing that analysis where appropriate to really understand how those impacts will play out, affect and ultimately affect your KPIs and financial metrics. And therefore be able to engage the affected internal stakeholders to make sure ownership is at a departmental and at a kind of business unit level, not just kind of there sitting with we've recognized that these risks exist, but the mitigation plan is not in place. So very much that final step of really testing your resilience, making sure that mitigation is at a sufficient scale to deal with that exposure to risk, but also that you're capitalizing on opportunities in a way of understanding where the business can position itself as a result of those opportunities coming through. So really understanding what's the right position to take and to capitalize on those opportunities. And just kind of on that scenario piece, I think it's an important area. And I think with some of the questions we see around this are very much that there's some key areas to think about. And selecting scenarios is always a tricky question. But thinking about some of these areas is usually a good way to start. So understanding, where is my exposure? Is it more on the transition? Is it more on the physical risk? And therefore, do I need to focus in on those scenarios that really answer very specific questions? Or do I have a broad set of risks and therefore I need to understand the balance between both sides of the coin? Also understanding kind of which scenarios really align best to your own growth projections. So understanding those that are really detailed in the areas of your key technologies. If you're very much looking at that energy sector transition, making sure that your scenarios are those that are detailed when it looks at the energy transition. Equally, no scenario is going to answer every question. So it's important to find those that are adjusted and most closely aligned to where your assessment is really going to be focused. I think it's also then the use of them is very much around the degree to which you're trying to get a certain outcome in terms of, is it all about quantification or is this around at a qualitative level, understanding the uncertainty. So therefore, how detailed and how important do you need to use those scenarios? Because in many cases, scenarios are really useful for just screening risk and understanding the nature of exposure without necessarily going all the way through to a really kind of deep dive into detailed financial modeling. So there's a use in both cases for kind of screening and looking at the overall exposure as compared to really getting into the detailed financial modeling. So it's also using it for, as I say, to answer the right questions. So yeah, I think those are just some of the questions I want to highlight. I'm sure there may be some questions at the end as well. Just as a final kind of point from me, just in terms of some of the work we've seen and some of the reflections on that. Really, yeah, I'd say it's key when approaching this to really look at the whole business, understand exactly kind of the uniqueness of your business model, make sure that you're looking not just at kind of general kind of sectoral drivers and what's changing in the sector, but really contextualizing in the uniqueness of the business model and making sure that's key and presented as part of what you're disclosing. I think it's then really important to make sure that the focus is broad enough, because we often see that the companies will narrow the focus really early onto some obvious risks, but often that means that the unexpected is missed and leaves some blind spots uncovered, well, sorry, not covered. And then I think, yeah, as I say, the scenarios provide that kind of what if, certainly, but the use of proven and the main scenarios that using, whether that's scenarios that sit behind the IPCC's reports, whether it's key kind of IEA transition scenarios, whether it's the key kind of integrated assessment models, all of these scenarios and the use of being able to say that you've taken a consistent approach to the use of scenarios is really provides a lot of confidence in the results that come out of this for those that are then assessing that disclosure. So what I would say is use of those proven scenarios provides a good comparability of your results as compared to immediately kind of going down the very bespoke angle where that comparability is often lost. And then I think, yeah, just in terms of the final elements, really I think it's making sure that you're not reliant on a future that looks the same as today is kind of the key thing when we really look at this. Is where you're reliant on the status quo being continued, that's often where a lot of these risks exist. But also in terms of understanding where your strategy can be enhanced and where it can actually really deliver on that creation of not just value today, but really capitalizing on those future kind of climate trends is where a lot of this comes through. So understanding where your decisions, of course, will worsen and exacerbate risk is key, but also understanding where you can kind of strategically really push beyond the current plans to capitalize greater on those trends and particularly understand where there may be some missed opportunities by working more closely with, as I say, some of those key partners within your value chain, whether that's at the sort of customer end or within the kind of partners within your supply chain. As I say, that kind of co-creation of those opportunities is the key thing. And TCFD can be the key kind of enabler to having that dialogue on how you de-risk not just your own business, but de-risk the value chain overall as a kind of key outcome of this as well. I think I'm just going to hand back now to Dominic just to tie things together.
Brilliant. Excellent. Thanks, Ben. So before we just go into the last 10 minutes and some time for Q&A, I thought I'd just try and draw together, hopefully, what some of the sort of key takeaways from the session might be. I think when I'm thinking about this, the key point for me is that there's approximately 170 companies in the world that are responsible for more than 50% of greenhouse gas emissions. Now, these companies are very much the focus of investor, lender, insurer, rating companies' attention, and as such, they're changing. Now, indirectly or directly, these companies, as they're changing, they're also your customers and potentially your suppliers. And so really the whole thing about TCFD is about you thinking about how much you have to change as well to adapt to this. And broadly speaking, nobody wants to be a laggard. I think in my mind, being a late adopter, playing catch up, being on the back foot can tarnish reputations. It can dent revenues. It can very much be costly and inefficient. So for me, this is where TCFD is this amazing opportunity to get on the front foot. And so we know that TCFD will be mandatory, so that's even more of the driver to really do the next most important thing, which is get your head around that whole value chain, the whole business model. Look up and downstream so that make sure that you do capture those benefits and avoid any blind spots. And don't bury your head in the sand. Whilst the climate is changing and it's going to take many years, still many years for those temperature rises to come through, there are some very fast moving risks that will be applicable to your business and your sector and your industry. And there are also some very key tipping points. We've seen how customer sentiment and can change very quickly about single issues. And so really understanding how those impact your business is key. And finally, the key takeaway for me is that this is so much more, and as we've seen, so much more than just a sustainability issue. This sits at the core of your business strategy. And so if you're going to be successful in this, and you're really going to test the true nature of where are your vulnerabilities, where are you strong, your flexibility that gives you resilience, and where's your capacity to adapt, you're really going to have to bring a lot of people on board internally, and that's going to take time, and it's going to take a lot of quite often a bit of persuasion. So hopefully this has been a useful session. I'd now like to just sort of hand over to Maddie to just deal with some of the questions that have been coming through. So Maddie, thank you.
Great, thanks Dom, thanks Ben. We've had a number of questions come in and I'm just conscious of the time, so I will try and cover as many as possible and group them where we can. So the first question that's come in is around timing, and if you could recommend how long does it take to achieve alignment with the disclosure requirements?
Great, thanks Maddie. So, we've made that point. This is a marathon, it's not a sprint. You probably saw from the case study that there's an opportunity to improve over time. When we've been working on this, what we found is that a lot of organizations want to internally get their head around this. They want to understand, what are those material risks, having identified and prioritized them, what is the size of the value at stake, and then when they've got that, they can start to think about what information do they want to releasing into the public domain. And in what order. So I think quite quickly, we've seen organizations, obviously as part of CDP, are already disclosing risks and opportunities. So quite quickly, you can actually get to the point over a couple of months where you'll be able to do a really good initial disclosure against those 11 questions. But I think if you're going to get to the point where you're talking about financial numbers, then we've seen that this can take, much more than a year. As you build that engagement within the company, as you get the finance team on board, as they start running the numbers through their financial models and really satisfying themselves that they're robust and that this is credible insight. So in short, you can get going in a couple of months, but the longer term, getting to that financial value at stake can take over a year, in my experience.
Great, thank you. Our next question is, we've had a comment that companies have often been criticised for a lack of detail, and we've given National Grid as a case study on meeting requirements, but what does best practice look like, and how do you know when you've done enough?
I think this is another good question. I think it's very much down to your stakeholders and the pressure that you're under. So you've got all sorts of different people who are asking for information, and depending what that is, that's one dimension. The second is obviously just to really see kind of what your peers are doing. And then obviously the third is very much what is the minimum level that's being asked for by the FCA, for example. So I think in the first instance, you have always got the opportunity to comply or explain. But in the second instance, I think it's really is about just aligning your disclosures with your key stakeholder group. So if that's investors, or if it's your lenders, or if it's your customers. So when it comes to best practice, there is an awful lot of information out there. There's a lot of organizations such as the CDSB, the Climate Disclosure Standards Board. There's guidelines out there about what good practice looks like. Accounting for Sustainability as a very good handbook as well. So just it's quite easy to go out there and get some really good information about what good practice looks like. But I think the key thing for me is just make sure you know what your stakeholders want and go at that pace. And then do that thing about where's there's opportunity. There will be advantages from first mover. So that can often drive the pace of what you're disclosing and when as well.
Yeah, I think from that standpoint, very much kind of within sectors, we've often seen, those leaders really set the pace of what practice looks like in the sector. Because often it's in a vacuum of what's good practice, the first mover gets to set the pace and gets to set the structure of things. So certainly, as we've highlighted, the uncertainty on the investor side means that when there's a lack of disclosures out there, really those that are setting the pace are really kind of determining what others then are put under pressure to do. So there's definitely that kind of sector lens to be put on it, and obviously the advantage in being the ones who are really kind of structuring that disclosure in a way that suits them and forcing the others to follow. But also I think, where we get into the more kind of quantitative elements, those that have the positive story to tell of not just risk, but the combination with opportunity to show that they are setting themselves up to be successful in mitigating the risk and not capitalizing the opportunity, are really the ones that can then put a really kind of a solid and quantitatively robust disclosure out there.
Great, thank you both. We've had a number of questions come in that are around the size of companies and what this means so to give you an example, which companies will TCFD become mandatory for? What's the definition of a large company for TCFD compliance purposes? And are there likely to be requirements for SMEs from the FCA? So it would be great if you could just give kind of a summary of what compliance means in terms of size of company and what's expected.
Sure. So I was going to say, yeah. So for this first round of mandatory disclosure, it's those with a premium listing. So it's going to be those large listed entities. The next round that's being looked at is then going to large on the basis of effectively kind of that 500 employees plus type scale. So that obviously brings in a lot more companies into scope. But as part of the consultation that will be done over the coming months is really understanding how that disclosure then needs to scale based on the size of entity, because certainly there's elements, particularly when we look at the complexities of scenario analysis, for example, where the capacities and capabilities of those that are, when we're getting down to more SME level, will be very limited. So we're expecting that there will be a bit of a kind of sliding scale of some of the more complex elements just because of the internal capacities that are available, but also, the more that this is led from those large listed companies, the more there becomes, a better, and as I say, kind of view of what the sector is assessing, and that then sort of really does set the practice for what scenarios are being then looked at within the sector. Sorry, Tom, go ahead.
No, thanks, Ben. That was great.
Great, thank you. And with 1 minute left, we've had a really interesting question come in, and I think it is a nice finisher to the webinar, which is all around that beyond disclosure and making the most of TCFD. And the question is, how does TCFD impact actual emission reductions as opposed to simply providing insight to the risks that companies face and how they are dealing with them?
Yeah, so I think that's a really good point. TCFD, for me, is the envelope that sits above your emissions reduction strategy. There's kind of 3 strands for when you're trying to decouple your business's success and growth from its environmental impact. And that's obviously energy efficiency, moving to renewable sources of energy, and ultimately it's around offsetting the small amount of residual emissions through greenhouse gas removals. So reducing carbon intensity is just one element of TCFD. That will reduce your exposure to transition risks through legislation, e.g. carbon pricing. It won't affect your impact. It won't reduce your physical risk exposure. And whilst if you have low carbon products and carbon neutral products that can help with your opportunities, it doesn't always necessarily, cutting carbon doesn't always fully open up those opportunities across the value chain. So I'd say TCFD is much bigger, and it's a strategic piece. It's about seeing how your business, how resilient is your business to climate related impacts, what are the opportunities to adapt, and what are the opportunities to capitalise on the transition to a low carbon economy.
Mm-hmm. And I think when we're building those decarbonisation plans, companies are often looking at decarbonising the model that operates as it exists, and TCFD also, does start to ask the questions of, what will that business model look like once we respond to those kind of external pressures. So it's also planning for a business model that may be fundamentally changed, whereas just rather than focusing just on kind of decarbonising what you have.
Great, thank you both. That does bring us to the end of the webinar, so thank you all for attending. You can see on the slide at the moment Dom and Ben's email address if you would like to get in touch. Also, we have a number of resources on TCFD on our website, thecarbontrust.com, and this webinar has been recorded and it will be sent to attendees afterwards, so you will be able to rewatch the webinar from today. So thank you everyone for attending and enjoy the rest of your day.
Brilliant. Thank you.
Thank you.